Hey guys, Nate Smith, Towne First Mortgage. Great to see you. We've got a panelist coming in today that are going to dispel any myths behind underwriting, property, all those questions that you have. We got Melina Lacey, our head of underwriting. We got Taylor Reeves, who is our team lead for collateral underwriting. And we got Audrey Bauer, who is Towne First Mortgage operations specialist. They're all here to give you guys some knowledge today. So come on out, check it out, hit the link below and learn something today. Thank you all for your attendance today. We actually have a pretty special panel up here. And I know when you hear the term underwriting, right? Everybody seems to think that that's some magical place where everybody's chained to their desk and nobody gets to talk to this underwriter, and all of these things happen, decisions are made, but you guys aren't necessarily in the loop. You just get the feedback, well, the underwriter said, or the underwriter wants, right? We have a panel of experts today that can speak directly to underwriting. First, we have Melina Lacey, who is our senior vice president, and the official title is Mortgage Corporate Underwriting Manager. She's my go-to when I get into problems and situations I don't necessarily understand, so we talk a lot. Taylor is an assistant vice president with the official title of Collateral Underwriting Team Lead. He is also my go-to when it comes to property-specific questions, appraisals, and anything condo related. Somebody mentions condo, I'm like, yeah, we're gonna need to call Taylor. And special guest, Audrey Bauer. She is our operations manager here at Towne First Mortgage. So she and I pull up weekly and get to discuss loans, and both good and bad. You know, ones that gives us problems and ones that are not necessarily a problem, but she is my go-to on a day-to-day basis as it relates to loans. So we are lucky to be able to pull them away from their desk. We unshackled them, so they are here really for you guys. And I'm gonna try to keep this like pretty light. It's more of a Q&A, but I have some specific questions directly, and then we can go any direction you want with this. All right, does that sound all right?
Yeah.
Good.
Yeah.
All right. And I know that wasn't really a full bio, so if you all want to like introduce yourself, your bio, like likes, dislikes, long walks on the beach,
we can
seafood.
do a little verbal resume.
Yeah, please, go right ahead. Melina, let's start with you.
I will start.
Okay.
So thank you for having me out. I have been in the business for over 35 years. I just celebrated my 10-year anniversary with Towne this past Saturday. Absolutely
Nice.
love my job. This is something that I haven't been out to visit you all previously, but I go out to realtor offices and builder offices all the time, just to have conversations about topics of interest to your side of things and my side of things. My entire family has always been immersed in the business. My grandfather was a builder. He sat on the board of a local bank back home. My mother-in-law passed a couple of years ago, but into her 90s, she was 95 years old. She was a broker. She still showed properties for select people with a chauffeur because she couldn't drive anymore. And I've got, you know, my entire family are real estate agents, realtors, loan officers on the banking side. So while I have absolutely zero sales skills, my hat is off to all of you, I do think I have a sensitivity. I understand what you all are up against. I know what happens on your side of things, and so I take my job very seriously. My gift, your sales, my gift is problem solving. And I've been at this so long, I know all the ins and outs, like the tips and tricks and how to get things done when we need to. And I always try to share with people, I think, in all of my years in the business, I worked for the biggest of the big dogs. I worked at Wells Fargo back in the day. And what makes us different, that I absolutely love because it makes my job easier, is that we have local decision making. 99% of all decisions from an underwriting perspective can be made at my desk. If I can't make it, I call, text, and harass our CEO on a daily basis. He loves to hate me or hates to love me, depending on how you look at it, but you will never find yourself in a situation where you're waiting for a committee out of Minnesota somewhere to make a decision that is staffed by people that nobody knows, that nobody has a connection to, that doesn't, have the rapport that Nate and I have. If there is a problem, we might be told, this is a true story. There have been times when there was an issue that popped up in the 11th hour, and we can touch on that later, like how does that even happen? 10 o'clock at night, 2 o'clock in the afternoon on a Sunday, and we are working through issues to make things happen. So I love the rapport that I have with our sales staff, and I really think that I have an exceptional underwriting department, so I'm very grateful and fortunate to have such a skilled staff to work with. But we work to our unofficial motto in underwriting is committed, creative, and connected, right? Things you don't necessarily associate with underwriters. Like when Nate brought that up, I think y'all are probably like, oh my God, underwriters are some mean people in the back room stamping denied on everything. That's really not who we are, and my underwriting staff knows that they have to pick up the phone and have conversations with people. That's how we resolve problems. We know how to be creative. You know, it used to be that 90% of loans fit inside the box. Now I would say maybe 10 to 20% of loans fit inside the box, that you can clearly look at a guideline that somebody published, Fannie, Freddie, FHA, whoever, that you can say, well, this fits that scenario. The rest of the time we gotta get creative and say, hey, could we fit inside the box? And we're all committed to getting the job done. Nate and I were joking earlier about how I have like a sports analogy for everything. I love to win. I like to play on a winning team. So that's where, you know, our paths connect, and we work so well together to try to make things happen. So. Taylor is part of my group as well. So Taylor leads up our collateral department. We have an entire collateral team that does nothing but review appraisals, approve properties, review and approve to rep and warrant condos and attached PUDs all day, every day, so that we're on top of those property-related issues as they come in, you know, versus, you know, an underwriter waiting to dive into that file. But I'll let him give you his little verbal resume as well. Did I just wear you all out?
No. I'm Taylor Reeves. I've been in the business for about almost 9 years now. I've been with Towne for 2, and I love everything about Towne. And you know, as Melina said, everything property ever, you know, my 8.5 years has been nothing but condos up until about 2 years ago. Still condos, and I love it. It's a very specialized kind of thing, and people get scared about the whole condo world because you have, you know, this list of all these credit guidelines and everything that you need to get to, but condos just a very small portion of it, but it's just as important. So I like to try to take, you know, alleviate some of the stress about the condo and really dig into it, work with the agencies, FHA, VA, and I always try to find a solution, I guess would be my motto. But other than that, she kind of hit on everything. I have a direct line to her. She's got a direct line to the CEO, so we're gonna make it happen. That's what we do.
Makes it good. That's right. That's right. AB?
Sure. So I actually work with Nate on a daily basis. I'm located in the same office in Innsbrook, and I work closely with the processors, underwriters, closers. You know, all of us work really well together, and I'm there for the loan officers as well. So you know, we all work as a great team. We do also reach out to our underwriting helpers, and Melina is definitely one of those when we do have our tricky situations and stuff. But yeah, me and Nate work daily together on the tricky loans and pull up on just statuses and our production and where we're at and everything. So that's kind of what I'm there for. I'm support for ops. So
Thank you.
Nice to meet you.
Very good. All right, let's get right down to it. What does an underwriter do?
So an underwriter, I don't think I really touched on that part of it. So I am over all of our underwriting for all of Towne Bank for the mortgage division. So I don't actually underwrite loans. I'm here to keep people counseled, educated, to handle exceptions, audits, you know, all the fun stuff ends up on my desk. But from an underwriting perspective, what an underwriter is doing is they're basically validating the loan information on the loan file. So a loan officer takes an application. In theory, I could underwrite an entire loan file with just the application and a credit report. You know, I still need that supporting documentation to back up what was in that application. But my borrower is telling me how they qualify. They're telling me a little bit about themselves, where they've lived for the last 2 years, where they've worked for the last 2 years, what kind of income do they earn, what kind of savings do they have, how are they going to be making that down payment and paying for closing costs, and how do they pay their bills as far as their liabilities are concerned. So from a credit underwriting perspective, I'm trying to validate 2 different things: that I am demonstrating that the borrower has an ability and a willingness to repay. So there's, you know, those 2 things are not the same. From a collateral perspective, I'm determining that the the value is there to support whatever loan the borrower has applied for, and I'm also determining that the property meets, our criteria for acceptable collateral. So not only the type of property that it is, but also the condition that it's in. So that's basically what we're doing. You're telling me, this is who I am, here's my credit report, and here's an appraisal for the property, and an underwriter is going in and validating that what you told me is accurate, and they're calculating income to secondary market standards and agency standards, and we're reviewing the appraisal from the same perspective as well. That is essentially what an underwriter is doing. They're verifying that the story that borrower has told us is actually true.
Okay. Do you have a different take, Taylor, or is that, I know she's your boss, so you probably have to agree.
Whatever she said is correct. No, I mean, yeah, we're making sure that, that we have, not only does the story match up, but we have all the documentation to support it. Because when the loan closes, it goes to these investors and goes to the agencies or whatever, they're not really looking at it through a common sense lens, right? They just want it black and white, checkbox. Is it there? Yes, it's there. Does it have what we need? Yes. So it's the final stop. Well, not the final stop, but it's the final say pretty much to be able to warrant the loan.
And I think that's an important point too. So from an underwriting perspective, so I'm looking at that loan file from the perspective of protecting our borrower, protecting our referral partners, protecting the bank, but we're also looking at that file from the perspective of how is someone else going to look at this loan file? So I'm looking at the loan file. I want to make it work. So if it looks kind of good, I'm trying to say, wow, this looks great, right? But an auditor, is going to come in. At any given time, this is a fact. I'm literally under audit right at almost every time. There hasn't been a time in the last 3 years that I wasn't under audit by some agency. I literally last year had FHA, VA, USDA, Fannie Mae, Freddie Mac, the FDIC, and the CFPB all in-house, examining our work all at the same time. So they're not just looking at our loan files, and they will request them. They'll say, hey, these 30 loan files, and we'd like to look at them, please. And they want to see what our processes and procedures are too. Do you do things, how do you say that you conduct business? Is it in compliance with regulatory requirements and agency standards? And also, do you do what you say you do? Because we're allowed as a company to have our own requirements that we have. As an example, we might have a minimum credit score requirement. We might say that in order to get a loan with Towne Bank, you have to have a minimum credit score of 620. They will go in and they will review our loan files to see, did you make any loans to someone who didn't have a 620? Did you make an exception for someone? If you made an exception, can that be supported by, with a fair lending exam? Meaning, if I said yes to Nate, but no to Audrey, could there be some discrimination going on there? So every little thing that we do at any given time is under extreme scrutiny. I will tell you that from 2020 and 2021, when lots of us were insanely busy, lots of things went by the wayside. So the things that we all do typically on a day-to-day basis to make sure that we're all doing the right things, some of that didn't happen. And I will say that it didn't happen for Fannie Mae, it didn't happen for Freddie Mac, it didn't happen for FHA. How do I know this? Because they started sending me requests for audit files for loans that I was joking, hey, this loan is literally ready for kindergarten, and you want me to go back and revisit like how we came to this determination and if the property was acceptable and things of that nature. So we are always trying to find a way to say yes. At the same time, we're always trying to make sure that at the end of the day, I always say I don't do boomerang loans, right? Once I sent it out, I want it to stay out. Once I've sold that loan, I don't want to see it coming back. So that's kind of like the lens that we're looking at everything from. So I always also share with my loan officers, tell me a story. That's something that I plagiarized from the Department of Veterans Affairs back in the day, long before we all had a computer sitting on our desk even. The Department of Veterans Affairs would come out to actually visit your office. And they would literally make you verbally defend your processes or verbally defend a loan file. You had to be able to sit there. You could access that paper file to remember what you were thinking at the time, but they'd say, well, why did you approve this loan? And you had to be able to defend it. So I remind everyone to tell the story, right? There might be a very good reason why this loan is acceptable or why this borrower had this issue with their income or their credit, but I'm not gonna remember what I was thinking a month ago. I probably might not remember a loan that I reviewed yesterday, right? But I'll remember it if I can jog my own memory with my notes. So tell me a good story, Mr. Loan Officer, as to what's going on with these unusual circumstances in the loan file. And then when my underwriter approves it.
The story has to be about that customer, right? It can't be about their mom.
Right, no. I need you to tell me your story. But telling a story is really important. And I think that's important in so many situations. So not to get sidetracked, but we just had this debate come up. I was at a realtor event last week, and the question of second homes came up. Like, what is actually a second home? I think a lot of us who've been in the business a long time had that 50-mile rule drilled into our head. That's not a rule, that's not a thing. A second home is defined by whether or not you spend some portion of the year in that property. If you truly intend to spend some of the time in that property, you can still rent it out. It can be a property that when you're not using it is being utilized for some income, but is there a story that backs up why this property could be a second home? And the loan that came up as a topic of debate was for a borrower who was buying a second home that, but as the crow flies, was about 3 miles from his primary residence. But in practical application, his location in Charlotte, North Carolina, it would take him so long to try to get home every day that he couldn't conduct the rest of his business. He's an international attorney. He has clients flying in. He is entertaining them. He is handling business situations, and he wanted to be able to walk across the street to his condo, and where he could have people spend the night if he needed to, where he could host them for cocktail events and things like that. And it made perfect sense. And all of the facts supported that idea that it literally takes anybody an hour and a half to get home. In that very short distance, it's just impossible to navigate traffic. So I said all that to say that telling a story, being creative, and understanding the guidelines is so important, and knowing how to make things work when maybe others, go for that, that quick and easy no. We're trying to put some time and effort in to say yes.
I like that. Okay. Very good. How long does it take to underwrite a file?
So a very vanilla loan, and I would classify a vanilla loan as a borrower who has, acceptable credit. There's no, derogatory credit events. They've got some pretty straightforward vanilla income, right? W-2 wage earner, nothing too fancy. They're doing an 20% down payment on a conventional loan. And by the way, don't they have enough money in their account to, support the closing costs and the down payment? That's vanilla. I could probably, one of my fast underwriters could probably do that in 25 minutes. I could probably do it in 35 or 40. I'm a little rusty because I don't do it every day. But I'd say, 30 to 60 minutes for your average typical vanilla file. We do have additional loans where somebody is credit challenged. So I've got a 620 credit score, and there's plenty of evidence in that credit report to inform why that credit score is low. Because there's derogatory events that have to be evaluated. And by the way, they've changed jobs 6 times in the last 2 years. And by the way, they need every dollar of overtime they've ever earned to qualify. And by the way, they're getting a gift from their mom. And by the way, they almost have enough money for closing, but they will when they get paid on Friday, which is the Friday before Monday when they actually close. And there's all these moving parts, difficult files like that. Or the flip side to that, hey, I am a highly qualified borrower on the surface. I've got an 800 credit score, but I have 16 businesses. So there's 16 sets of business returns that need to be evaluated. And by the way, I'm such a involved business person that I have years that are a loss and a profit, and a loss and a profit, and a loss and a profit. And unfortunately, from a cash flow perspective, for a bank shelf type product, you might easily qualify, but when calculating income to match secondary market and agency standards, you might have a borrower who on paper looks like they're very qualified, but once you dig in and start calculating that income, they actually might have a net loss across all those 17 businesses. And those clients are difficult to deal with sometimes too, because they come with that expectation that I am well qualified. What do you mean I can't? I could buy this house for cash 3 times over. I don't need your mortgage loan. It's difficult to not only underwrite a loan like that, but give that valuable feedback to the loan officer so they can have that conversation and explain why we're having some challenges and what we might be able to get across the finish line. So a loan file like that, option A, which is a barely qualifying borrower or a very involved borrower, there are those loan files that could take a day or two, or more to underwrite. We had a loan file that we joked about that had it been a back in the day file when we were, actually dealing with paper files, it probably weighed 40 pounds. I mean, it would never be audited because nobody would want to take it apart, because this borrower, we had a borrower that came through with 101 businesses. So guidelines tell me I have to individually evaluate every one of those 101 businesses. So there's a lot of work involved in that. I think that took the underwriter an entire week.
Okay, so it's not a set
It's not
number.
a
It
across
can
the
change.
board easy,
Okay.
answer to that, but
Yeah.
generally speaking, about an hour, I would say.
For those out in the audience, anybody heard of the term LP or DU? Show of hands. One? That's it? Wow. All right. Loan officers, you guys know that. LP and DU, they're agency Fannie Mae and Freddie Mac underwriting engines. What's the difference between that and Molina?
So LPA, Loan Product Advisor, is Freddie Mac's proprietary automated underwriting system. DU is Desktop Underwriter, it's Fannie Mae's tool. But if you were to read through the materials that are published by the agencies for each of these two automated underwriting systems, they will tell you that the results that you receive, it's kind of, the concept of, garbage in, garbage out. First of all, data integrity is important. I'm only getting an answer as to whether or not this loan is approvable according to the AUS system based on the information that I've input, but it is simply a recommendation. All of the materials available that describe these tools tell you that it's simply a recommendation. It is not a loan approval. Thank goodness, because we wouldn't need underwriters if the system could exclusively underwrite and approve these loans. It's a valuable tool. It will tell me if a loan is approve or accept. Those are the terms that they use to call a loan approved. There are also those that come back with a finding of refer. And what refer means, it means it's being referred to an underwriter for a manual underwrite. And that is a different set of criteria. It's a little bit more restrictive than it would be for an approve or accept loan file. So a manual underwrite is always going to be a deeper dive with much more conservative restrictions on what is approvable or not.
You touched on, thank you. You touched on a couple of things that I think may be important to illustrate. I think we've all had clients who've had multiple jobs, multiple bank accounts, not necessarily a whole lot of money, but I got enough money now. Can you speak to what an underwriter likes to see as far as trending?
So every one of the agencies will tell you that changing jobs frequently is not in itself a problem or to be viewed as a bad thing, right? I might be on the fast track in, advancing my career, and, I've got the foundation to be a whatever, fill in the blank, whatever I do for a living, but I've got, I identified a better opportunity and I moved up for a better position, or I moved up for a higher salary, or maybe I moved up for, maybe I changed jobs for other reasons. Maybe I found I was fortunate enough to find a job in my chosen field, but it was a an hour and a half commute, and now this opportunity comes up and it's closer to home. So these frequent job changes are not in itself a problem. But what I am looking at when I'm looking at anybody's income and employment, whether they're self-employed, whether they have a regular job, is can I demonstrate stability and continuance of employment and income? So for an example, something that comes up often when we have those more difficult loan files is situations where, let's just say that, I took a new position tomorrow and I was earning double my salary that I earn now. And now I want to buy a house. And I only qualify for this house that I want to buy based on this brand new salary that I have absolutely no history of ever earning before. Well, that job and that new salary is not necessarily a layering of risk and an issue unless I need it to qualify. If I were buying a house that I could qualify on the salary range that I've been in for the last 5 to 7 years, well, I've demonstrated I know how to earn X number of dollars per year, but I have absolutely no history of earning, this new job that's brand new. And by the way, if I lose this job, if I decide, ooh, this is not for me, and I have to revert back to what I know, then I'll be reverting back to the level of income that I have demonstrated that I've earned, that it's been stable and consistent. So stability and consistency is what I'm looking at. I don't really care that you've changed jobs. I care about, what you've demonstrated you can maintain on an income level. And I'm looking at whether or not, if this new opportunity that you have from an employment and income perspective were to go away tomorrow, where would you be? Would you still be able to pay your bills? It might be that, you've got a situation where, that, obviously you're using your current income to qualify, but maybe my debt to income ratio is 22%, right? And if, I decide this isn't for me and I revert back to my old job, well, maybe my DTI would be 45%, but I still qualify. It's not that concerning. But that's what I'm looking at. It's not the job changes that are so concerning. It's whether or not you're stable. You do see, people that come through sometimes that they work 2 months at this job and then 4 months at just this job and 6 months at this job, and they're kind of related, but really they're in fields all over the place. And by the way, now you just landed this new job, but when I look at your W-2s for the past 2 years, you've consistently earned about $50,000 a year. But now you've got the new job at $85,000 a year. Well, part of what I'm looking at is, wow, you haven't held any job for more than 2 to 6 months at any point, and you've been on this new job for 30 days. I'm having a little heartburn getting to a point that I can make the determination that your income is stable and reliable when you haven't shown me that any job opportunity that you've had has been stable and reliable. And by the way, I need all this new money to qualify.
Yeah.
So that's
Okay.
a good example.
Yeah. All right, let's continuing with the income trend. And I'm sorry, a lot of these questions are gonna be directed right towards Melina.
No, that's fine.
But we'll get
Well, I'm
together
shy
in a
and I
minute.
don't like to talk, so.
COVID.
COVID.
COVID happened, everybody went to work remotely and are still working remote
Mhm.
in some cases. What kind of problem does that represent? Or what do we look for at that point to ensure that we've got stable, reliable income?
So, that is a great question. You can open it up to the topic of COVID here in a minute, but so when it comes to working remotely, there are those folks that have worked remotely, you know, for a very long time. It's not new to them, but I think in 2020 and 2021, a lot of us gained the privilege to work remotely, and it was a new thing for us. I can tell you that at Towne, we literally almost sent all of our operations home to work remotely for those that could, that their job, you know, description and the tasks they have to complete would allow for them to be off site. But we literally sent everybody home overnight. I was nauseous. I was ready to, I just thought it was gonna be horrible. It proved to be amazing. Everybody did an exceptional job. But we didn't have a remote work policy because we never needed one. So
My wife sent me back in.
it taught us that,
She didn't care if
I
I
know
got
that's
sick.
right. It taught us that we needed a policy and that most companies do have a policy. And you might not have the exclusive right to work remotely. When do I care about it? Well, I don't necessarily care so much if, you know, you're buying a house in Glen Allen and you were, you know, living down the road somewhere in the county previously. But what I do care about is that you decided, oh my God, I've been living in Colorado all this time and I hate it and I'd love to go back to Virginia where I'm from, but I didn't necessarily clear it with my HR department and that I had the, you know, permanent right or privilege to work remotely. So what I'm looking for again is back to the stability and continuance of income. Does your company say that it's okay, you can maintain a primary residence anywhere, and that you do or don't have the requirement to report to a location that is not local to the subject property? So maybe in my job with Colorado, I had to show up for once a month for a meeting. Well, do I care about that? Do I really need to have a primary residence in Colorado if my company says it's okay that I don't live there and I only have to show up once a month? No, right? So I could still have a primary residence in Virginia. I'm just gonna be flying to Colorado, you know, once a month as an example. But if it's a requirement that I spend 4 days a week or two out of 5 days a week in the office in Colorado every week, and now I wanna move to Virginia, that's a problem. So the question then becomes an issue of not just stability and of employment and continuance of income, but occupancy. Can you logistically maintain a primary residence in Virginia if you have to spend 2 days out of every 5 in Colorado? Probably not. Sounds like maybe Virginia might be a second home. But having said that, that's what my underwriter's gonna look for. Do you have the permanent privilege to work remotely? Is it gonna be in conflict with your job or the occupancy of the subject property? And is it gonna impact your income in any way? Every now and then you'll see a company where, you know, the pay scale for Colorado is X, but, you know, Virginia is Y. It's just a whole different pay scale that, you know, you're moving, but it's gonna actually impact your income and not in a positive way. And then there are those cases where, as an example, we do business in a lot of different states at this point at Towne. We've really expanded over the last couple of years. But we only allow employees to work in states that we do business in because we've only got the, all of like the tax ramifications and the different like employment laws and stuff, like that's pulled into how we administer payroll and benefits and things like that for employees. So, you know, I could have an employee that says that would tell me I want to move to Florida or Alabama or Louisiana or Delaware, and all those things might be fine, but as soon as you tell me you want to move to Oregon, I have a problem. I don't have employees. We don't actually have a policy that allows for employees to work out of Oregon. So those are just some of the things that go into it, and that's what my underwriter will be looking for, that you can make this move, that the occupancy of the subject still makes sense based on the requirements of your job, and that your employment and income won't be impacted.
Okay.
But touching on the COVID thing, one of the questions that
There's
comes
always
up-
a but, guys.
comes up often, but not a but, and I should say and. So I often get the question, is COVID still a thing? Do I actually even care about COVID anymore when it comes to mortgage qualification? So the answer is sometimes yes, not as much as it once was, impacting all of us, but the two situations that COVID could still impact someone being eligible to purchase a home if they need mortgage financing are sometimes an income perspective for those folks that are variable earners. So self-employed people are variable earners. People who earn and need to qualify, overtime, bonus, incentive are variable earners if we need that to qualify. And agency requirements differ by loan type and the approval level, but generally speaking, I'm doing an average for a variable earner, right? I can't say, well, your salary is $100,000 a year, I use that to qualify. I can, but if you also need that overtime that you earn, or you also need incentive, I'm averaging, right? So I might be doing a 12-month average, but I might also have to do a 24-month average depending on the loan type. And when that happens, if there is a period in the most recent 2-year period, and that's the look back period I'm required for that loan type, if I have to average over 24 months, and in that 24-month period, there was a work stoppage, you were on furlough, you had your hours reduced, maybe your job title was completely changed for 6 months out of one of the years in question, we've seen some folks that were like professional, I'll call them professional wait staff, like people who work for high-end establishments, you know, wait staff that earn $150,000, $200,000 a year. There are those folks out there. But during COVID, when they had to close all their doors, you know, they didn't necessarily get kicked out the door, but they were, you know, packaging up takeout orders and greeting people, you know, at the street, and their income was dramatically impacted. Well, now they're back to work and they're earning the same level of income that they once did, but as a variable earner, tips, right? If I had to look back and average in that 6 months where you weren't even earning close to what you did before, it might impact your purchasability, right? How much house you can actually buy, because unfortunately there's that work stoppage period in the most recent look back. The one agency that came out with some flexibilities for us and some relief is FHA. FHA says that if I can demonstrate that your business was closed during that time, or that your employer says, yes, that person was furloughed, or that they were working in a different capacity, then I could segregate that period and remove it. So in theory, if in that 24-month period there were 6 months that were impacted and I can demonstrate that, then I can do an 18-month average versus a 24. Every other agency has not given us any guidance that allows me to do anything but a 12 or 24-month average as is required by the loan type. So in those ways, it's becoming less and less relevant now that we're in 2023 and almost everybody was back to work in a full capacity and their businesses were open in 2022. So 2021, 2022 is the average I'm looking at, generally speaking. In most cases, 2021 wasn't as impacted as 2020 was, but that's one of the situations. The second time that you can be impacted is whether or not you have a borrower or a house buyer who availed themselves of CARES Act forbearance. So that is a forbearance that the federal government offered where you could defer or you were actually deferring mortgage payments whether you needed to or not. So there's 2 ways to become eligible for mortgage financing again. If you have availed yourself of CARES Act forbearance. If 12 months have already elapsed, then you're automatically eligible again. However, if you recently resumed making payments in one of 2 ways, so there's remediation and modification. Remediation means, you know, I skipped 6 months because I was out of work, but you know, now I've got the cash, I caught up those 6 months payments, and I'm back to making regular payments. If that happened, I am immediately eligible again. However, if you said, well, I'm back to work, I can make my mortgage payment again, but I can't catch those payments up. So those don't go away, right? They tack them on to the end of the loan. But under a modification agreement in those instances, I have to have made 3 monthly timely payments before I then become eligible again, and they cannot be prepaid. So, you know, if I went under agreement that my first new regular monthly payment would be in August, I have to make August, September, and October. After that October payment has been made, then I am eligible again. The one exception to that rule is with FHA in a certain capacity, because the other way out of all of that is to sell the house, right? If the house is sold, every other agency, Fannie, Freddie, USDA, VA says you're eligible again. FHA says if you are under modification at the time that you sold the house and you had not made your 3 monthly payments, so maybe you went under modification, you made 1 payment, you sold the house, but you were 2 payments shy of meeting that 3 payment rule, you're eligible, but you're only eligible for a manual underwrite, which is a little bit more restrictive from an FHA perspective. Ratios are capped at 40 over 50, 40 for your housing obligation, 50 for your total debt obligation. And there are other requirements. You have to have 12 months of clean credit. You have to have a 1 month PITI reserve in place. So there are some things. So those are the situations where COVID can still actually be a thing and you actually have to still care about it. If that person has variable income, it is a possibility. And if that person availed themselves of CARES Act forbearance.
Thank you.
You're welcome.
We're gonna switch gears.
Okay.
Property.
Okay.
How many of y'all out there, by show of hands, have had an appraisal come in and there were repairs requested? So a good number. What does that mean? This is probably for both of you.
I'll start. Okay. So, I know, that's a shock. So, every loan type that we have requires that the property be in acceptable condition. So it doesn't matter if we're doing a jumbo non-conforming loan, conventional, government, it doesn't matter. There are minimum property standards that are a requirement. I think it's a little bit of a misnomer sometimes that, conventional is so much easier than government loans, and maybe, during tough times with low inventory in place, sellers are more apt to want to ratify a contract with conventional financing versus government financing. And I think that sometimes that's a little bit misconstrued. So minimum property requirements are an issue and something that needs to be cured for any appraisal type. So if the appraiser calls out that there are repairs that affect the safety, the soundness, or the structural integrity of the subject property, the health and sanitation of that property, then those things will always need to be resolved prior to closing. That is true for conventional, it's also true for government loans. Are there slightly stricter standards for government loans? Sometimes, but not necessarily. Anything that is considered cosmetic never needs to be cured. It doesn't matter what the loan type is. So, floor coverings, paint, wallpaper, things like that, those are all things that are cosmetic, and nobody should ever be requiring that they be remedied. Now, I will say that it can affect your value though, because the condition of the subject property, all those cosmetic issues will come into play in rating the condition of the subject. And that's included, appraisers are required to report condition of a property from a holistic standard. So, just one area of the property that's deficient doesn't make the whole property, fair condition. It's, a combination of things that contribute to the condition of the property.
Well, you mentioned paint, peeling paint.
Right.
Do we have to fix it?
So, absolutely, from a government standard, all peeling paint will always need to be remedied. So that's true for FHA, VA, USDA. Conventional is a little bit more of a gray area. Without rambling too much, I will tell you that if you read conventional guidelines, so Fannie or Freddie, you will find absolutely no references to peeling paint. It's just not there. Lead-based paint, it's not there. Where it is there is if you read their guidance to lenders on what you can do if you're going to foreclose on a property and reclaim that property. We are not allowed to reclaim a property that has peeling paint or evidence of lead-based paint. So what I generally tell my collateral underwriters is to look at the appraiser's detail. Let's say I've got a little bit of peeling paint, right? Window frames, window sills are a frequent flyer item for those types of issues. Well, what does the appraiser say? Well, when was the house built, right? So if it was built after 1978, I really don't care. There should not be lead-based paint. Conventional loan, we can keep it moving. If the property was constructed prior to that, so maybe it was built in the 60s, but it was completely renovated in the most recent 15-year period, then chances are that peeling paint is also not that much of an issue, and that's not something that we would require be done. So government, always, conventional, maybe not, depending on the age of the property, the date of the last renovation of the property, and other things that we can construe from looking at the appraisal report.
Sticking with property, what happens when the property doesn't appraise for the agreed upon sales price?
That's a great question.
Does that ever happen?
I always like to say there's a difference between, I think we all learned this, in a painful way, especially in 2020 and 2021. I will tell you, in my 35 years in this business, I have never seen so many appraisals come in that did not support the sales price. But I always say there's a difference between is it a low appraised value or was it a high offer price, right? So I think that with, veteran, experienced, skilled realtors, if you're the listing agent especially, you did your research, you knew how you derived that price point, right? You knew that there were comps available, you knew that you weren't just pulling a number out of thin air, there was a lot of research and knowledge that went into setting that price. But in this inventory shortage situation where people, put in a bid and lost it, and put in a bid and lost it, and put in a bid and lost it, and they're desperate now, right? I want that house. there was a lot of creative verbiage that got added to contracts, right? So we all saw, you know, I will pay $10,000 over the next highest offer. I will pay up to, even if it doesn't appraise, I'll pay up to $25,000 over the appraised value, you know, up to my offer price, blah, 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 blah. And that all sounded great, and it was creative, and I applaud everybody for doing whatever they needed to do to get there, but my feeling is that deep down, when you made that offer to cover a spread, you were really hoping that the appraised value came in support of your offer. You didn't really want to part with that cash to cover the spread. And when that happens, now your feelings are hurt, right? And now there are folks that are like, oh my God, you know, what's wrong? This is a terrible appraisal. This is appraisal, you know, is wrong, and the value should be higher. I think if you're the listing agent, you probably already know, right? You knew, okay, we'll make this offer, but I hope that you're prepared to, you know, come up with that extra cash. But so the value comes in low. That appraisal is going over to the collateral department. They're going to review that file as quickly as they can in real time. We actually give priority treatment to properties that have repairs noted or low values. We want to get an underwriter to look at that file as quickly as possible. So they are analyzing that appraisal from, you know, a manual perspective of all the things that are required from agency guidelines, all of their knowledge and all of their experience. But we also have some really valuable ancillary reports that are mandated, their use is mandated by the agencies, where they're giving me red flags of information they're pulling from big data tools. They're giving me farm lists of comps that may or may not be available in the area of the subject. So we may be able to make a case right off the bat that we see evidence of undervaluation, and we're going to have my underwriter reach out to the appraiser and say, hey, I'm looking at this list of potential comps in the area of the subject, and it looks like, you know, 123 Elm Street and 456 Oak Street both sold, you know, are very similar to our subject property. They're within a half a mile of the subject, and they both sold for X, which is a value that is close to our sales price. Could you tell me? We've got to be really careful when we speak with appraisers, because it can never be construed that we're, you know, trying to influence them in ways that would be inappropriate. So we don't say, can't you use this comp? What we say is, could you please explain for us why you did not use this comp? Please explain the exclusion of these comps that appear as though they would bring the value in at a higher level.
What happens if the comp's closing tomorrow?
Right, so another thing I like to remind everybody, an appraisal is one thing and one thing only. It is a snapshot in time. It is the value of and the condition of that property on the day that the appraiser inspected the property. So a really good tip, if you, I think maybe we're moving out of this area, but we're still there to some degree. If you know that you have a property, whether you're on the buyer side or the listing side, and you know that there is a comp that's about to sell, that's the most primo comp ever, and it's really gonna lock in that value for you, and it's closing on Friday, let's go ahead and schedule the appraiser to go out on Monday, not Thursday.
The following one, not Monday.
The requirement for a comp to be used to establish value is that it has closed, right? So I can use active listings or pending sales to help establish trend, but I can't use them to actually establish the value there. So absolutely, I always recommend that, you know, you time those appraisal inspections properly, so that if there's a great comp out there, that my appraiser can actually use it in that appraisal report. But to kind of expound further, you said, well, what happens? Well, two things are happening when we're reviewing that appraisal to determine, do I really have a bad appraisal, right? So we have an internal appraiser panel and roster, so we don't use an AMC. We personally vet every appraiser that we do business with. So generally speaking, those appraisals are high quality, but there are times when we go off panel for whatever reason. We might get an appraisal that we're required to use by, you know, per agency requirements. If that appraisal comes through, we're doing two things. I'm trying to determine, is it an appraisal I can rely on for lending? Maybe it's problematic for whatever reason. My underwriters are making that recommendation, and I'm looking at it to determine if I agree that I just can't use this appraisal. The second thing I have to do is be able to demonstrate that I've exhausted communications with that appraiser. I want to work with that appraiser, if I can, to get to an appraisal that is at a quality that I can rely on for lending, that may or may not support your value. If I cannot get there, then strictly speaking, from a non-conforming USDA, FHA, and conventional level, I may authorize that we order a whole new appraisal. And when that comes in, we're gonna review it, and I have to type up a love letter for the agencies and explain, why did I allow us to order a whole new appraisal, and why am I using the appraisal that I'm using to rely on for lending, whether that value came in higher or not.
So we can't just order a new appraisal.
I have to be able to demonstrate that I've done all the right things and that there is a reason. I can't have it look as though I'm like hunting for a value. VA is the exception, so I do not have that same latitude or authority to just, authorize a whole new appraisal be ordered. So hopefully everybody knows, so VA appraisals follow the veteran. So if they started with lender A and now they moved on to lender B and they've already got a VA case number because they're under contract to purchase a property, that appraisal will follow them, and we have to use that same appraisal. FHA appraisals
Question I have.
follow the property, whole different thing. But with VA, if your value came in low, I will actually tell you that over the last couple of years, even though I have a love-hate relationship with the Department of Veterans Affairs as far as like the home ownership part of the VA, they were very, very helpful to us, especially during these difficult times when appraisals were not coming in support of sales contracts. The policy is, so if you need an increase to the value, if your value is low inside of a 5% tolerance, then it used to be that any party to the transaction can make this request. It changed in May of 2019. The veteran must make the request in writing, but they can request that they want to request a reconsideration of value. That letter or that written request is passed on to the Department of Veterans Affairs, to the Regional Loan Center by my underwriter. For our area, it's Roanoke. And generally speaking, within a day or two, they will review. If there is a case to be made to increase that value, the Regional Loan Center can increase the value up to 5% with nothing further needing to be done. If you need greater than 5%, that is not a quick process. That has to be escalated to central office, where they will dispatch a field appraiser to come out and actually reappraise the entire property if they think that it's warranted and there is a gap in spread in what they believe to be the actual value of that property. When that happens, 30, 45 days, maybe even more. But VA has their own process for that. But generally speaking, with VA loans, if it's coming in low, I don't know if you all are familiar with the Tidewater Initiative, but VA appraisers are required to notify the person who's listed as the contact for access to the property, to tell them, hey, I've done my preliminary research and I do not see information that supports a value in line with your offer price on the contract. And they give us 48 hours to provide some rebuttal. So to come up with some comps or just some reasoning as to why we think that value is there. So in theory, they're supposed to give us that opportunity to give them the ammunition they need to bring in that value prior to them delivering the appraisal.
Yep. Let's talk about the appraisal. Can anybody here have a customer that needed a loan, went to one loan company, and halfway through decided, you know what, I'm gonna go to another loan company? That ever happened? Yep. Okay. Can the appraisal be transferred?
So VA appraisals would have to be transferred, and so the VA requires that lenders, if you get a request from another lender to transfer that case number to you, which is what gives them access to the VA portal and that appraisal, we must transfer that appraisal to the second lender for that same veteran. But fun fact, so if you happen to be maybe the listing agent on a property and the deal fell apart because the value did not come in support of your offer price, and now so the property goes back on the market and borrower number 2 is also utilizing VA financing, you're going to get a whole new VA appraisal. So that's another opportunity to potentially get an appraisal that supports that sales price. FHA, that appraisal is good for 180 days and it follows the subject property. So same scenario, you're the listing agent, 123 Elm Street is under contract, the borrower is utilizing FHA financing, it falls apart, but the appraisal's already been ordered, and now you got a new borrower in there that is going to purchase the property, and they too need FHA financing. You are stuck with that same appraisal. I will tell you that all is not lost though. So both VA and FHA require that if that transferred appraisal comes through, it doesn't matter if lender number 1 underwrote the appraisal and accepted it. My underwriters have to also review that appraisal and accept it. And it's also still subject to reconsideration of value. So the same rules apply. Just because lender A ordered the appraisal, received it, reviewed it, approved it, and now I have that appraisal in for a new borrower, but still for that same property, it might not be a good appraisal. I can't speak on or the quality of the work that another lender does has nothing to do with me. So I may very well determine this is not an acceptable appraisal, which may or may not be something that's good news for you. If the value came in low and I say, hey, I hate this appraisal, you might be like, yeah, I hate it too. Let's get a new one. So there are still opportunities even on a transferred appraisal. Conventional appraisals, so it is very much frowned upon. Appraisers are not required to transfer appraisals. We like to be able to demonstrate like the provenance for an appraisal, that we know that we ordered it from one of our trusted panel appraisers, that we know how it came through to us, and we want the ability to request corrections as needed. What we do, so no, unconventional appraisals, but what we
Thank
do sometimes do, let's just say that you have a borrower who is working with another company and they're pursuing conventional financing, and they've got this appraisal, and there's, it doesn't appear there's anything wrong with the appraisal, and shoot, they just paid $575 for it, they really don't want to pay for another one. There's some options that we have there, but generally speaking, our appraisal desk can reach out. If it's an appraiser that is on our panel, we might reach out and say, hey, Bob, you did an appraisal for 123 Elm Street last week. We've got this borrower now. Would you would you update this appraisal for us? And generally speaking, a lot of our panel appraisers will say, well, okay, for $150, I'll revise the report. So a new effective date, a new appraisal report in our name. So, it's a flexibility there. It's not perfect, but it's not, as bad as saying, hey, I need a whole new appraisal with a whole new appraiser, right? So that's part of that equation too. As many people who stir the pot, it gives, more opportunity for issues to come up. So since you already have an acceptable appraisal that we like with Bob, we'd like to stay with Bob if we can.
All right, I have some additional questions, but I want to leave time for questions from the audience. So, right now, are there questions from the audience? This is your opportunity. This is Oz, right? Or the great and powerful. They're behind the curtain all the time. You got questions, scenarios, issues? Please. Yes, Jeff.
So when you plug all of that information into underwriting and it spits back an answer, is it just approved or not approved, or do they come out with grades like this is a better loan, because you guys are ultimately selling them, right? So
Great question.
Can you sell certain ones for?
That's a great question.
Profit?
There used to be levels of approval.
God, EA1, EA2.
Right, expanded approvals, right? So that kind of went away, I'd say at least 12 to 14 years ago. So we'll speak on conventional loans for the purpose of this conversation. So conventional, Fannie Mae is either approve eligible, Freddie Mac would be accept eligible. So the first part of that equation means that your credit is acceptable or approved. Eligible means that the scenario meets eligibility requirements. So there's a difference there. You may be approvable all day long for the details of the loan, but you might not be eligible for whatever reason. So two pieces there. The other criteria would be refer, meaning it's a manual underwrite, so you're not generating an automated approval. But even though it's either approve or not approve, basically, there's very detailed feedback that's provided. So you get messages that analyze the transaction, whether it's a purchase or a refi, and if you're meeting those eligibility requirements, you're getting credit feedback. If the system identifies issues with the credit report, you're getting asset feedback if you're not necessarily meeting the minimum reserves requirements that might be part of that loan file. You will get feedback. This is my personal favorite and my personal pet peeve, because I always tell my team, I don't know if anybody in this audience is old enough to remember what RIF is. Remember RIF, reading is fundamental. I plagiarize that logo all the time. I put it in emails all the time. Read your feedback, because it'll give you some clues to things you might miss
I'll just say it's a lot for a loan officer to read through. I mean, there's 3 pages of stuff.
Would be seller paid, interested party contribution, seller paid, that's something that's entered in that loan file. So for conventional loans, if I'm, at greater than 90%, I'm capped at 3% seller paid contributions. Under 90%, I can go up to 6. Under 75, I can go up to 9. But on an investment, I'm capped at 2. So there will be times where that figure is wrong, and there'll be a big old message on that feedback that says your seller pays are exceeding allowable contribution for the program. So one level of approval, but lots of valuable feedback for those people who actually read on my team is very helpful. It will save you a lot of pain in the end.
Usually I read the problem ones when it's a problem, then I start reading. Just kidding.
We got people for that.
Yeah, exactly. I'm not very good at reading. All right. Other questions? Yes, sir.
People that got FHA or VA loans in 2021, are you guys seeing any of those coming back as qualifying assumptions?
Great question.
So that's a good question. I hear a lot about assumptions. We do not intentionally, I will say, service government loans at this time. And it's the servicer, the holder of that loan, that is facilitating the assumption. So there's agency requirements that need to be met, but any mortgagee can implement their own overlays to how those are handled. So while I don't see them myself in my current capacity at all, because we don't service government loans, I'm hearing a lot about them. So at all of these realtor events that I attend, I've been hearing a lot more often, especially when there are folks who are trying to, say, VA, and they want to do a substitution of entitlement so that they can free up that entitlement. Maybe, maybe they purchase at the height of the market and there's really no equity there, but they can go ahead and release that entitlement back to themselves so they can go make another purchase. I'm hearing a lot about that. So yes, it is happening more and more, and I'm noticing that the agencies are publishing more guidance. The VA just published a newsletter the other day that reminded lenders that you have a responsibility to facilitate assumptions. You cannot opt out. You can have your own guidelines, but you may not opt out.
Does the VA have to be a veteran?
Yes.
It does.
It does.
On assumptions, yeah.
And interestingly enough, you actually don't have to substitute your entitlement. It's kind of a disconnect for me. I've never really understood why I would want to leave my entitlement tied up. I guess there are those situations that it would make sense, but it is actually not a requirement. So generally speaking, that's the purpose behind it. You don't have any equity and you want your entitlement back on a VA, but I also see situations where it's like a family transfer and they want to, leave that family member with the benefit of, the terms that they acquired at the time that they bought the house, which are arguably so much better back then than they are right now.
So if you don't know what we're talking about, people that have really low interest rates right now, if it's FHA or VA loan, those loans could be assumed by a new buyer. So you don't have to go out and get a whole new loan. You don't have all the fees and you get that interest rate. So what they would do is if they owe, $500 and they want to ask $550, you pay $50,000 and you take over their payments. So you're getting a great rate and it's easy and it's something that wasn't even practical for many times, but now it is. So if you have sellers in that position, that could be a tool that helps you sell that house.
Absolutely.
Sure.
Absolutely. If you got a government loan and they're moving and they've got a fairly low interest rate, that is a marketing piece you
Huge
guys can
selling
put out
tool.
there.
I mean, who wouldn't want 2.75 versus where rates are right now?
So ask your sellers what kind of loan they have when they're selling.
Does the veteran have to assume it though, or does the same kind of loan?
For
have
VA,
to-
you said it has to be a veteran, but for FHA, it doesn't have to be.
So-
Okay.
No requirements for.
No requirement other than
Qualifying,
qualifying, right? So you still
Back in
have
the day,
to
you didn't
qualify
have
for
to
that
either.
loan, no different than how the,
No income requirement, just do whatever you want.
but it's a huge selling tool. It's an opportunity to, acquire that property and have, terms that were only available 2 years ago that nobody can get right now.
Wicked smart. All right. Jeff.
So there are servers and bartenders in Richmond that are making $200,000 a year.
Yeah, really.
Look, I question that too.
Outside the country where
I
you
think
guys
that's
work.
high end. I don't
So,
frequent those
I will,
places.
I'm not using specific names, so we just did a loan for a server who works for Ruth's Chris, at the beach, who made $194,000 last year.
That's only at the beach.
That's
though.
reported.
That's resort area. High crime.
Wow.
But I've seen others. He mentioned resorts. We've seen some folks that work at some of those all-inclusives in Florida.
Yeah.
And the money they make is, that's why I call them professional wait staff, because that's a real job, right?
Yeah.
That's not like trying to get myself through college.
All right, we have reached our hour mark, so we're gonna hang out for a little bit, but we appreciate you guys coming in, developing your skill set, and learning from some of the best. So thank you guys for coming in.